Good morning. My name is Brant Steck. I'm Vice President at BUI. And on behalf of the entire BUI team, welcome. It is my pleasure to introduce our speaker today, Mr. Marty Shenkman. But before doing so, I have a couple of important items to address. Number one, first and foremost, a big thank you to our friends at Protective Life for today's sponsorship. Without their support, this meeting would not be possible. If you're not familiar with Protective Life, where have you been? Very competitive products, very competitive underwriting, and the combination of those two things leads to a lot of favorable planning solutions for your clients. So to Kurt Nolde and his entire team at Protective, thank you for your support today. Secondly, this meeting is approved for 1 hour of continuing education credit for CFPs and Missouri attorneys. So 1 hour CFP and 1 hour of Missouri CLE. If you're not a CFP and you're not an attorney, just enjoy the meeting. If you are a CFP and or a Missouri attorney, I will put a link in the chat feature of this meeting here as soon as I'm done with my comments. All you'll have to do is click on that link, enter your information in, and we will get you the credit. If you do not complete that link during the meeting, we will not be able to give you credit, so please be sure to take a second and do that. Now, on to our speaker. Our speaker today is Mr. Marty Shenkman. He is a nationally recognized estate and tax planning expert. He is an attorney. He's a CPA. He has his MBA. He has written over 42 books, published over 1,000 articles, and can fill a page with his many awards. His credentials speak for themselves. But what you're not going to see on his bio is that this is a good guy. I can tell you over the years, we've worked with a lot of different speakers, and I've never seen a single one donate 100% of their speaker fee to charity. And now we've seen Mr. Shenkman do this more than once, this time to the American Brain Association. A super nice thing. So not only does he have a good brain, he's got a good heart too, and I think you will really enjoy the fresh planning ideas that he's going to share with you for how to plan in 2021. So without further ado, Mr. Marty Shenkman.
Thank you. So what I'm going to do is talk to you for the hour we have about planning in the current environment. And Brian, Michael, the team from BUI, I've invited them to interrupt me anytime they think something is worth elaborating on, or if they think they have a question that may be of interest to you. And what I'm going to do is, some of the topics I'm going to talk about may sound like they're targeted to lawyers, and some will be, but I'm going to also spin and try to identify what financial advisors and insurance consultants should focus on, because financial and insurance planning is absolutely essential to the success of really almost every estate plan. And too often, just in general, the financial and insurance components get overlooked. I will tell you with absolute certainty that the planning at the end of 2020, it was a mass rush to get work done before the end of the year on the fear that the Democrats might gain control, and in fact they have. And because of that mass rush, a lot of the planning done last year is ripe with opportunity for financial and insurance advisors to go back and help fill in pieces that just there was no time for. And we'll talk about that. Now, the focus, though, is right now we're living in a uniquely uncertain and dynamic time from a tax planning perspective. And that uncertainty means opportunity. So what I really want to emphasize, and that's the key of this whole thing today for the hour, is the opportunities that all of you have, that we all have as advisors, to better serve clients and help clients do good planning right now. So that's what we're going to focus on. So I think everybody's familiar with where we are, but let me just say it because it's obviously critical to the planning. The Democrats control the House, slim majority, but they have control. The Democrats now have a 50-50 tie in the Senate, and we're going to talk a little bit more about that. But what happens when you have a tie in the Senate is the VP casts the deciding vote, Kamala Harris, and obviously she's going to vote for what the Democrats are proposing. Now, that doesn't mean it's good, and the Democrats obviously have the White House. That doesn't mean it's going to be easy for the Democrats to push through any agenda, in particular tax agenda they have, because the Democratic Party is certainly complex and varied in terms of what many of the Congress men and women stand for and what they want. But I think it's very likely we're going to see significant tax change. And I think it's not only a question that we're going to see it politically, but I think given the massive bailouts that have already occurred, the additional bailouts that are going to most likely be proposed and some form of them enacted, from a budgetary perspective, I think we're going to see tax increases. And that is critical. What should clients be doing now? We are very likely to see, although we can't be specific because we just don't know what's going to come out of the legislative process, significant income and estate tax increases. So what needs to be done, certainly from an estate tax perspective, we're going to go through it more, is the third bullet point on line 6, is people need to be looking at creating irrevocable trust and making transfers to them. And that's what we're going to focus on. Now, if it sounds like, gee, how can the Democrats with a 50-50 split in the Senate push through tax legislation? If you don't recall, I'll remind you, in 2001, that's exactly what happened. There was a split, and then Vice President Dick Cheney cast the deciding vote enacting the 2001 Tax Act. So we're not without precedent. Now, what about a filibuster? If you have budget reconciliation, and I think also judicial appointments, those are not subject to the filibuster. So this is definitely change that the Democrats can push through. And we're going to talk about what some of that may mean. Slide 9. Let me walk you through what I think are some of the most critical factors that we all as planners and advisors need to advise clients on. Now, the first bullet point on slide 9, gee, that may sound like something for an attorney to draft, and I assume there's some attorneys on the call, but my understanding is most of you are financial advisors. But this is something every advisor needs to understand. If the attorney for the client doesn't understand what bullet point 1 is about, planning may not be done ideally or appropriately for your client. You're being aware of what bullet point 1 is, and we're going to spend a lot of time talking about it because I want you to understand, is so essential that if the other advisors aren't aware of it, you need to bring it up. And there's options, specific, practical planning options I'm going to give you. So let me explain what this is now that I've laid the table for it. There is a possibility, and we're going to talk more about it in a few minutes, that the tax changes that the Democrats push through could be made retroactive. Now, that's not without precedent. We're going to talk about that just briefly in a few minutes. But they could pass a tax change in June that is effective January 1, 2020. Now, my personal view is that just seems a little too unfair. And with the slim majorities they have, I just don't see that happening. That being said, my Ouija board long ago burnt out, and I'm not going to make any predictions politically. But let me drive home with a simple mathematical example why this is so vital. So Brian hasn't used his exemption, and Brian's going to give away $11.7 million to a trust for his family. He's going to lock in his exemption, get great asset protection planning, and grow these assets out of his estate. So if Brian finishes this $11.7 million transfer February 1 to a fancy, nice, irrevocable trust, what happens to Brian if June 1 Congress passes, and please don't say it's never going to happen, it doesn't make sense because you can't apply it's never going to happen in anything politically in our country. You just don't know. But if Brian made the transfer in good faith on February, knowing that right now today, the exemption's $11.7 million, if June 1 they retroactively enact this, and the new gift exemption based on what's already been proposed last year by Bernie Sanders in the Senate and Congressman Gomez in the House for the other 99.8% tax act, it's already been proposed. It's been talked about by the Democrats for more than a decade, a $1 million gift exemption. That would mean that Brian has just made a $10.7 million taxable gift. Brian will not be happy. Now, I acknowledge it's unfair. I acknowledge that kind of retroactive change is unreasonable. It would seem they'd have to give you a way to undo the transaction. But is that a risk you want a client to take? I don't think so. So here's what I think needs to be done. We all need to plan, and I'm going to focus on this in a second, on aggressively helping clients that did not complete planning last year, shifting wealth as soon as possible, because the sooner they do it, perhaps the greater likelihood that it'll be done before the effective date of any new changes, in order to use the current estate tax exemption. But what I think we want to do, apropos to bullet point 1 on slide 9, is we want to use some creative mechanisms, and I'm going to walk you through 4 of them. Only 3 are in the slides. I thought of another one last night that I will share with you that didn't make the slide deck, to deflect that kind of risk. So if I can tell Brian, you can make the transfer and use your full $11.7 million exemption, but I have a couple of clever ways that if they do actually enact a retroactive tax change, acknowledging that I don't think it's that likely, but it's certainly in the realm of possibility, we can avoid a tax on $10.7 million. Brian would not be a happy trooper paying $4 or $5 million in gift tax that he doesn't anticipate paying. So that's something I'm going to go through, and it's really critical. Now, if you're a financial advisor, if the attorney is aware of this and can deal with it, you're done. You brought it up, it's been addressed, you're fine. But if your client's attorney is not aware of this issue, it's something you need to bring up. And hey, if you bring it up and there's a discussion with the client and the client decides, you know what, I'm fine taking that risk because I think that's just so ridiculous it's never going to happen, then it's on the client. But you don't want to not bring it up. Okay. Now, the second bullet point, access. This is absolutely the most essential aspect of planning. When I lectured last year, I said this was the number 1 issue that had to be addressed. And I think it still is the number 1 issue when you are doing planning to capture exemption for most clients. If a client's worth $100 million and the client is going to use up an $11.7 million exemption, unless the client's lifestyle expenses are pretty extraordinarily high, it's probably a safe bet that a client at that level can give away about 10% of their wealth and be okay. But if a client has got a $20 or $30 million net worth and is going to give away $11.7 million, that's potentially 30 to 50% of their wealth level. Can they afford to do it? And the answer is the answer to every legal question. What's the answer to every legal question? It depends. It depends if the planning is done right. And that's what you want to make sure happens. And this point, number 2, is where you as a financial or insurance consultant will shine. And this is where there's lots of gaps in the planning, and I'm going to talk to you about it. And if you may already know it, and if you don't know it, when I say it, you go, oh yeah, that's obvious, but it's not being addressed. We need to preserve access. So if a client were $20, $25, $30 million is going to give away $10 million, we have to make sure that they have enough cash flow from work or other income coming in, not counting the 10, 11, 11.7 million they're giving away to support their lifestyle. Otherwise, we have an issue we have to deal with. Now, the most important way to deal with that is when these trusts are structured, and we'll talk about this, and there's a lot more slides than I'll really get through, but I want to just bring it to your attention so you know to raise the issue. And what I've actually done in the slide deck is I've given you sample legal language, knowing you're not drafting documents, but if the attorney for the client is not familiar with some of these techniques, you have the resources to call the attorney behind the scenes and help them get some information so they can do it. We want access. So if we set up a trust, we want to make sure the client can get at it. Now, one of the most common techniques, and it's not without risk, and we'll talk about it, and you hold one of the keys to make it work with insurance planning, is spousal lifetime access trusts. Now, these are such a great tool that I not only tell clients about them, it's the foundation of my own personal plan. My wife, Patty, set up a spousal lifetime access trust. It's a trust. Hers is set up in the state of Nevada because it's got more favorable laws than our home state. I and all of our descendants, children and grandchildren, are all beneficiaries. I set up a different trust in Alaska for my wife and all our descendants, and she's a beneficiary. So long as we're both alive and married, we have access as beneficiaries to 100% of the money we've given away. Now that's beautiful. We've used exemption. We've done great asset protection planning because I believe those trust assets will be very difficult for a creditor or a claimant to get to. And yet it's out of our estate and we've used exemption. And we did that back in 2012 when the first potential drop in exemption was being talked about. So that's the heart of planning. You want access, and the clients need access. Now, hand in hand with that, and we'll talk a little more about it, is the appropriate financial modeling and forecasting and insurance planning. And you probably already thought of a big part of the answer for that. We'll talk about this point and others in a few minutes. But one of the risks we face, if my wife is the beneficiary of the trust I create, if God forbid she dies prematurely, I lose the indirect access to the trust because she's no longer alive to be a beneficiary. Can anyone on this call think of a planning tool that can be used to address mortality risk? I'll give you a hint. It begins with the letter I. So if my wife buys life insurance on her life inside her slat that she created for me, if she dies prematurely and I lose access to my trust, the insurance can make up the difference. And hey, by the way, there's just no way with the rush, the mad rush to complete planning last year before the end of 2020. And there were tons of clients that rushed to get planning done because we all felt pretty confident that if you finished it before the end of the last year, even if something was retroactive, it wouldn't be retroactive to a prior year. They can actually do that, but I don't think any advisors thought that was a risk. But go back to all those clients and talk about mortality risk and help fund that in the SLAT plan. Third point, which I've already mentioned because it's inherent in everything, is using exemption. Many of the Democratic proposals have included reducing the exemption for gift tax purposes to $1 million and $3.5 million for gift and estate tax purposes. It's presently $11.7 million. Doesn't take a lot of deep thought to understand, boy, if somebody's worth $20 million and they can put a big chunk of that in a trust and capture and preserve a big part of their exemption, that their heirs are going to be a lot better off. So using exemption is one of the keys of planning now. Now, that's what we talked to clients about last year, but I will tell you from my personal experience as well as from talking to colleagues, we were busier than I've ever been in my entire 36-year career. I've never seen anything like the mass amount of work done last year. That being said, a large portion of my clients never did planning. I wrote them letters, I sent emails, we did probably 20 different webinars last year. They were emailed about all of it. Every client had to know that they should have planned. I wrote letters to some, I called some. A large part never planned. Now that it's clear that the Democrats have control, there's no theoretical question anymore. They have control, and I think it's very likely. I think most tax practitioners assume we will have significant tax increases. No one can guess exactly how, what, when, where, why, but I don't think there's a tax practitioner in the country that doesn't anticipate significant tax changes. All of us, whatever specialty or field you're in, we all need to contact all the clients that did not plan last year and say, hey, get on the bandwagon and plan now, because if you miss the train, it may be gone forever. Once this train's out of the station, it may be gone. So using exemption is critical. I always put down asset protection because we live in the most incredibly litigious society. There is nothing, I don't care who's in charge in Washington, we're not going to change the culture of America. I mean, you see all the 1-800 billboards, you know, when you drive into a city, in a crash, need cash, call 800, let's sue or something. We travel cross country for a charity we have. This is the first year in a dozen years we haven't because of COVID. But we always admire the lawyer billboards outside big cities. Our favorite one that we've ever seen was, just because you did it doesn't mean you're guilty, and then an 800 number. But we live in a very litigious society. Every client you have should be doing asset protection. And I have news for you. Every one of you on this call should be doing asset protection. Everyone on this call. Everybody. So that should be factored into it. And by the way, it's actually a good thing, because if you're doing asset protection planning and you're doing tax planning, often the same steps work for both. It's not often common that planning for one objective is consistent with planning for another, but with estate tax planning, it really can be. You just need to tweak the documentation that the lawyer does and some of the planning tools to make it work. We can have a wealth tax enacted too. Keep that in mind. I can't promise you that shifting wealth to an irrevocable trust before the law changes will avoid a wealth tax, but it may. So that's yet another reason clients should be jumping at doing planning. Now, here's my view of the planning world, and I think it's absolutely critical. No one should be doing estate planning without the full involvement of the financial advisor, the insurance consultant, the trust officer, the accountant, all the allied professions. We all need to work together. And lawyers often don't do it. And I will say some financial advisors often try to do the planning without involving the lawyers and the accountants. It's a mistake. We all need to do this as a collaborative team effort. The world we live in is way too complicated, changes way too fast, and there's just no way that everybody can be expert in everything. When my bio was read, they didn't mention I'm also a registered investment advisor. I don't do anything in that field. I have an MBA in finance. I don't use that. I rely on the financial professionals. I could certainly go out and buy software and do a financial model, but you know what? I have my hands full keeping up with the legal side of it. I want someone who does that stuff weekly, if not daily, to use their expertise to do it. So if I'm doing a plan, I tell all my clients, have your wealth advisor, your financial planner, your accountant, have them do some modeling and forecasting so we can see what this looks like. Having a Monte Carlo simulation and showing what the results of a plan will look like 10 and 20 and 30 years from now is a real eye-opener so a client can understand what to do. It often also highlights some of the ancillary planning. So for example, if my wife dies prematurely, not something pleasant to think about, but it's a reality, what do I do to make sure I don't run out of money? Now I can give you, and in the slides, we won't get to all of them, there's lots of clever ideas to preserve access if a spouse dies prematurely. But boy, don't forget the simple one. Buy life insurance to fill the gap. Maybe you use life insurance and some of the techniques that we're going to talk about. But again, planning should be a team effort. Now, I'm going to point out some other aspects of that as we go on. But that's really critical. The next few slides, I'm going to skip through because I don't think they're as important for you. But let me just say what they're about. There has been some really worrisome litigation that I have seen, not just against lawyers doing estate planning, but against accountants doing estate planning. One of the really ugly cases, big scary numbers that I've seen, the financial advisor in the last court document that I was able to see that was made public mentioned the wealth advisor, but hadn't yet brought them into the case. I think it's only a matter of time. So I think collectively as professional advisors, we all need to be careful. When a client, and I'll tell you what I think the most significant risk issue is. If a client is really uncomfortable, and we've all seen this, making transfers to trust, giving up any element of control over their wealth, don't push them. If a client's going to be really unhappy having done the planning, be careful how hard you push. You don't want them to go ahead with the planning and then come back and blame you. On the same hand, if a client doesn't want to do planning, send them an email, save it. You know, you really should be looking at the potential for tax increases in doing planning now. So we all need to be careful. Slide 14 has a list of some of the things I try to do when I do significant wealth transfers to help protect the client and all the advisors. I have a solvency affidavit signed. It's a fairly simple legal document that says things like, I'm not past due on any alimony or child support. I have enough money to support my living expenses for the foreseeable future. I'm not aware of any claims outstanding that could affect the transfers I'm making. The client is protected by signing that because it's being done now contemporaneously with the plan, and you as advisors are protected. Make sure there's a balance sheet. I can't tell you how many times I've seen all sorts of advisors do planning and not have a balance sheet for the client. How can you tell what a client can afford to transfer if you don't have the numbers? And my preference is I don't want to prepare a balance sheet as a lawyer. If the client will listen, I'd really rather their wealth advisor and or accountant prepare it, because that's what you guys do all the time. I love having forecasts. I love what if forecasts. So the client can't come back and say, golly, you didn't tell me, that if such and such happened, I'd have a problem. Well, if you've done some financial modeling, you've integrated a lot of that. I think it really helps clients understand it. So let's go on to that. Now, this is a piece that, yes, the lawyers will have to implement. It's the first bullet point I talked about earlier, and I just want to take a couple minutes and talk about it. Because I'm assuming most of you are financial advisors and not lawyers, I'm going to just mention some of the things here. Slide 16 tells you a couple of the cases that occurred that give a basis for Congress to enact retroactive tax change. Just look at the second bullet point. The retroactive law has to be rationally related to a legitimate legislative purpose. Can you think of a time in our history as a country where raising revenue has been more important with the bailouts that we have? So, even though this is something that hasn't happened much before, please don't dismiss it. If you have clients in real estate looking to do 1031 exchanges, 1031s have been on the chopping block. They've been talking about getting rid of that forever. So that's something that, bring to the client's attention. If you got a 1031 you're looking at doing before the law changes, maybe you want to ask your real estate lawyer, can you build something into the contract to unwind the transaction if the law changes? Now, here I'm going to give you now 3 ideas. I'm not going to belabor them. I just want them in your toolkit so you can bring them up. So we don't want, if Brian is giving away 11.7 million February 1 and they retroactively make the exemption 1 million for gift tax purposes January 1, and is it really unfair if it's already been proposed? Not sure. So here's one of the techniques. The trust that Brian creates, and perhaps even the transfer documents making the transfer of the assets to the trust, will include the right for a beneficiary that we designate to disclaim or renounce the assets on behalf of the trust. So the trust that's the donee, the receptacle, the beneficiary of Brian's gifts will have a clause saying, Brian's spouse, I don't know if Brian's married, but he will be for our example, either way. Brian's spouse is deemed the primary beneficiary, and Brian's spouse is granted the right to disclaim all interests in the assets that Brian contributes to the trust. And if Brian's spouse disclaims those assets, they don't go in the way of a normal disclaimer. So if spouse dies and there's kids, it goes to kids. If Brian's spouse, and put it right in the trust, if Brian's spouse disclaims, those assets revert to Brian. Now, what does that accomplish? In a half a page of language that the lawyer sticks into the trust, I've now given a mechanism for up to 9 months after the transfer, and 9 months from February 1 when Brian makes the gift. We'll certainly know what the tax law is going to be. Brian's spouse can disclaim and unwind any part of that transaction. So let's say they make the exemption $5 million, no inflation adjustment, the $5 million that was in the 2017, or actually it was, I think, 2012 Tax Act. The $5 million exemption, Brian's spouse could disclaim $6.7 million, and Brian will have only given away exactly what the exemption, no unintended tax. That to me is a great safety valve to build in, and it ain't a big deal to do. Now, it's not 100% guaranteed it works, but hey, if the IRS has an issue with a mechanism like this isn't the taxpayer playing games with the system. We don't know what the law is. How can you hold us accountable? I think it's an excellent technique that's worthy of consideration and integration into every trust plan you do. And by the way, and this is probably a topic for another lecture, no client should ever transfer a lot of money that's not going into trust. You don't give money outright to kids or grandkids. It should all be in trust. Why? Because this way Brian's spouse can be a beneficiary. I can give you lots of mechanisms to benefit Brian. I can build in disclaimers. You got asset protection. Don't let clients give money outright. Another approach, and again, I'm not going to dig too deep, but I just want this in your toolkit. If Michael is married, Michael could give his 11.7 million amount, or let's say he's not going to give 11.7. That's too steep. He's not comfortable. 8 million, 5 million, whatever it is. We could create a trust that is like a spousal trust. It is like a trust that qualifies for the marital deduction. And I'll explain what I mean by it's like that. So the requirements to qualify for a qualified terminable interest property Q-tip marital deduction, standard kind of marital trust, is that Michael's spouse has to get income at least annually from the trust. Michael's spouse can be the only beneficiary of the trust during the spouse's lifetime. No one else can get at the money. And if the assets in the trust aren't income producing, Michael's spouse has to have the right to demand that the trustee make them income producing. So I'm going to create a lifetime trust like that, and Michael's going to put in the $8 million in this hypothetical. Now, why did I structure this like a marital type trust? And what do I mean by like a marital trust? It is a marital trust. But what in the tax world makes a trust a marital trust is when Michael files a gift tax return electing to have that trust treated as a Q-tip trust for marital purposes. If it's treated as a marital trust, he uses 0 exemption. So that gives Michael until October 15th, 2022, when his gift tax return is done, to figure out what he wants. So Michael can make a transfer. Any of your clients can make a transfer today, if they have a spouse, to a trust like that, and have to almost the end of next year to figure out what the tax treatment is. So once we know what the tax law is, we see what the stock market does, the client's got all that time to decide what they want to do. And if Michael decides, you know what, based on the change in the law or the retroactive change or what the market's doing, I only want 5 million of that to be out of my estate. So if he gave 8 and he only wants 5 to be out of his estate, the Q-tip election's made for 3 million. The other's out of his estate. That's a creative way to give your client lots of time to figure out what they want to do. And hey, by the way, the point of all this stuff is clients that may be concerned because they've heard about retroactive tax change, you got the solution. You don't need to draft it. You don't need to get into too much depth. But now in your little toolkit, you got now 3, as soon as I give you the next one, solutions to solve the problem, to encourage clients to plan. You can also have a client make a formula gift so that let's say the client puts their marketable securities in an LLC, or they have a family business that's in an LLC or an S corp. They're going to give to their trust a portion of the LLC interests based on a fraction. The numerator, top of the fraction, is what their remaining exemption is after consideration of any retroactive tax change. And the bottom is the fair value of the asset. So what we've done is we're fractionalizing it. If their exemption is exactly 11.7 million and there's no change retroactively, and that's the amount that they were to transfer, then the whole thing goes. If there's a retroactive change, it reduces it proportionately. So there's 3 ways, and here's some sample language. I'm not going to even talk about it. That Jonathan Blottmacher, a colleague of mine, developed an interactive legal software company. He has permitted me to use it. But if you have a client's attorney that is not familiar with this, hand them the outline. There's a 4th way, using a tier of grant to retain annuity trust, that I just thought of, but I don't want to belabor that. So let me just summarize where we are, do a little bit of recap. We'll talk for just a couple minutes about income tax changes, and then we're going to jump into more detail on the estate stuff. So here's the foundation I wanted to build. The Democrats have slim control, but control nonetheless of the House, the Senate, and the White House. The Democrats have talked about significant increases in taxes on the wealthy for more than a decade, maybe much longer. It certainly seems with the deficit issues, and I'm not being political, I'm just speaking from a tax perspective, some of the social agendas in terms of concentration of wealth, which COVID exacerbated, that I think there's a great likelihood that a lot of these changes will be proposed. I can't tell you which ones, how much, or when, but I'd really be shocked after doing this for 36 years if we don't see significant tax increase. You will be doing a great service for every client of yours if you reach out to them and say, hey, have you done all the planning that may be appropriate for you? Clients that did planning last year, lots of them didn't go to the nth degree because they weren't sure what would happen with the election. Now's the time. A lot of clients were still sitting on the fence last year. Talk to them. Don't let them lose out. When you're doing the planning, key concepts. You don't want someone getting nailed by a retroactive tax change. I don't think it's very likely. It just seems inherently unfair. And with the slim majority, I don't know that they'd push something like that through. But hey, if you can use one of the 4 techniques that I told you to mitigate that risk, why not take the protective course of action? Make sure when your clients do planning, it's done holistically with the accountant, the attorney, the financial advisor, the insurance consultant, because holistic, collaborative planning is always better than siloed planning. And I use the phrase siloed because so often you'll see the attorney drafting documents and doing a plan, never communicating to the financial people. That is not the way to fly. Make sure that your client, and we're going to spend some time talking about this, I want more little tools in your kit, has access to the money. Because unless you're dealing with super wealthy clients, they don't want to lose access because they may need it in the future. So that's going to be critical. That's the foundation that I built. I think that alone gives you great opportunities to go out and connect with clients and give them really valuable information. Now, I'm going to do this quickly because it's not really the focus, but to talk about tax change without just hinting at some of the income tax changes that could be substantial, I think would be a mistake. So slide 25. We have if you're self-employed, 12.4%, Social Security tax. Forgive me, I don't do tax returns. I think it goes up to about 144 grand, something in that range, 160 grand of income. And then on income above that, you don't pay the Social Security tax. They're talking about uncapping that. So the proposals I've seen talked about, well, up to 400,000 from like 100, let's say it's 144,000 where you pay tax. They're going to leave no tax up to 400, but then kick it back in at 400. So if somebody earns income, a physician client of yours makes $1 million, that's another 75 grand of income tax on top of the income tax, just for the Social Security tax on the piece from 400,000 to $1 million. So a physician earning $1 million, another 75 grand of Social Security tax. Tax rate going up from 37 to 39.6. And hey, don't forget our favorite NIT, the net investment income tax. So on investment income, on top of the 39.6, they can have another 3.8. On top of that, if it's earned income, they're going to have the 12.4. Capping itemized deductions at 28%. So the Democrats may want to bring back the SALT deduction, state and local tax, but they may cap all deductions at 28%. So even if they kind of give you some stuff, it may be capped. So if a client's in a 40% tax bracket and their itemized deductions can only have a benefit of 28%, there's another significant haircut. The 199A deduction that we, attorneys, accountants, financial advisors didn't generally qualify for, but our clients often did, that may be phased out. And the magical number I see coming up in a lot of the proposals is 400 grand. So it seems that under 400 grand, they're not going to do tax increases. In fact, at lower levels, they may even reduce taxes. But for anybody that hits 400 grand, and I'm assuming that's the bulk of your clients, lots of higher taxes. 26. Capital gains rate, if your income is over $1 million, 39.6%. No more favorable capital gains rate. Ouch, right? That will have a huge impact on planning. By the way, what are you going to do? You're going to be really actively involved every year with clients on gain and loss harvesting. If a client's in a range close to that $1 million, maybe you want to goose them up just under the $1 million so that next year they have a little less income and stay below the $1 million. So smoothing income, using charitable remainder trusts is a nice way to smooth income because you put money in the trust can sell it. No current capital gains, but it comes out under the 4-tier system. So they're going to have income in every year, say for the next 20 years, but you've smoothed it so they're under the $1 million. CRTs, wealth replacement trust, right? You all know about that. So another insurance opportunity. But we will have a huge, huge amount of work to do if these changes go through. And hey, by the way, can you imagine if they make effective January 1, 2022, an elimination of capital gains on deals over $1 million? Can you imagine what December is going to look like? We're going to all cancel Christmas, Thanksgiving and do nothing but sit at our desks and work as every client next year tries to get every deal possible done before the effective date of the doubling of the capital gains rate. It's going to be a wild ride. Now, I don't know when this is going to go through, but we got to talk to clients about this stuff. SALT deductions may come back. And by the way, the most significant issue I didn't have here, I'm sorry, Biden has talked about eliminating the basis step up on death, right? So Michael bought Tesla at 5 cents a share. I don't know what it's at now, $1 gazillion a share. You know, it seems to go up exponentially every day. Huge built-in gain. Well, maybe he keeps that until death so that the capital gain is eliminated by a basis step up on death. They're talking about getting rid of that. There's even been talk about adopting a Canadian system where you have a capital gains paid on death so that all the appreciation, you got a capital gains on death. Do I hear insurance planning? Gain harvesting? Think about how radically that changes investment planning. All of us that help clients with financial matters, all of you have been aware that for a client that's in their 80s, if they have highly appreciated stock, they should sit on it until they die. We may set up a loan facility, borrow money, make gifts to use exemption from an estate perspective, but they're going to sit until they die on those highly appreciated positions. That may be all out the window. Dramatic change. Now, again, we don't know what's going to happen, but boy, shouldn't we be talking to clients about this now? Now, that's done for income tax. Just wanted to keep your juices going and making sure that was on your radar. I'm guessing it kind of was, so I didn't spend a lot of time on it. But one of the pieces when you talk about estate planning that often gets less, kind of like the Rodney Dangerfield of estate planning is the income tax. That's why you got to have the financial advisors and the accountants involved when the attorneys and the others are doing estate planning, because the income tax component could be so vital, so very vital. Now, we've talked about the basics and why you want to talk to all your clients, why they want to plan, how to protect them from a retroactive change. And now we're going to talk in much more detail about what are some of the mechanisms that you can use for planning. There's no way I'm going to get through all the slides and all the material. I just want to give you ideas so when you're at the table, you can bring them up. And what I'm going to do for most of the 18 minutes we have left is I'm going to kind of talk about slats primarily, because that's kind of the default plan that lots of practitioners are using. And I want to make sure you understand some of the nuances, the financial planning and insurance component to it, and how you can help guide clients. Now, I've already told you, the core of my plan are non-reciprocal spousal lifetime access trusts. Wife set hers up in Nevada. I set mine up in Alaska. Why Alaska? Why Nevada? What's non-reciprocal? You don't need to be a legal expert, but having a little bit of knowledge of this will help. The reciprocal trust doctrine is a tax and legal doctrine. It's not just tax, really important to know that says if my wife and I set up trusts that are almost identical, too similar, the IRS and a creditor, think of your doctors doing malpractice planning, can uncross the trust as if we did nothing. Unravels the whole plan. So why is my wife's trust in Nevada and mine in Alaska? Because the state laws in each state are different. She has Premier Trust, which is a trust company in Alaska. I have Peak Trust, which is a trust Premier Trust in Nevada. I have Peak Trust in Alaska. Different trustees, different state laws. There's some legally distinct and significant differences between Nevada and Alaska law that help make those trusts different. I build in all kinds of legal stuff to make the trust even more different. But if you don't differentiate the trusts, the whole plan comes undone. So if your client goes to an attorney that's more of a general practitioner and not an estate planner, and if your client's beating up on the attorney to keep the cost down, the attorney can do what you've seen done in a lot of old basic ILITs for decades, where they do, let's say, husband's ILIT, they flip-flop the names, and now you got wife's ILIT. No. Identical trust, reciprocal trust doctrine, they lose to creditors, they lose to the IRS. Don't let that happen. You got to create differences. I don't mean to sound like a salesperson for insurance, but I know a lot of you are interested in insurance, and it really does work. So what's an interesting way to differentiate my trust from my wife's trust that we did. She's got an insurance policy in her trust. I don't have one in mine. If she's got a large life insurance policy on her life in her trust, doesn't that make her trust economically, substantively different than mine? I think so. And if you want insurance in both trusts for mortality risk, if the wife has or spouse one has a 10-year term policy and spouse two has a permanent policy of any kind of stripe or color, those are pretty different, aren't they? I think any of you could argue how different they are. So insurance is a great tool to differentiate the trusts as well as providing for the risk of premature death. So spousal lifetime access trusts, why are they a default for many planners? Because whatever money my wife and I put into our trusts, I'm a beneficiary of her trust. She's a beneficiary of my trust. If we needed distributions, and we don't, I'm still working, right? But when we need distributions, it's already years after we set these things up in 2012, but I can get distributions out of her trust. She can get distributions out of my trust. What a great retirement plan. Great asset protection planning. And hey, for the kids and the grandkids, we've safeguarded our exemption. And all the growth in our estate since 2012 that's in those trusts is out of our estate. It's really a win-win. Now, I want to take a minute because this is really important because it's not often addressed enough to focus on what was the second bullet point on that slide where I said the key things to think about for 2021 planning. First was making sure you don't get your client nailed with a retroactive change. I'm not that worried about it, but why not take the precaution and try to be safe? Second key point, which I said was the most important point last year, is access. There's other ways to get access. So you already understand out of the box, my wife's a beneficiary of my trust. I'm a beneficiary of her trust. We've used some life insurance. What else can we do? Slide 31. Loan provision. Lots of lawyers used to put loan provisions into a trust because it made the trust a grantor trust for income tax purposes. If somebody, say Michael can loan me money, he's in a non-fiduciary capacity, has the power to tell the trustee, loan Marty 100 grand out of the trust. That right to loan me money without adequate collateral, without adequate security, makes the trust a grantor trust. Now, people stopped using the loan mechanism because there was a revenue ruling a few years ago that seemed to give great certainty to using a swap power, where I can swap assets and that makes it a grantor trust. Why not leave the loan provision in for access? Even if I'm not a beneficiary of the trust I set up for my wife and descendants, if I know I can call Michael and say, hey, Michael, I need some money. I got to get a new car. Could you please call the trustee and tell him to loan me 100 grand? I have access. Do I care if I die owing my own trust money and accrued interest? I don't care, but it gives me cash flow for whatever I need. What a great tool for access. This mechanism was designed to accomplish a specific income tax goal. Forget about that. It's nice and that's good, but think of it from access. 31 at the bottom. When I was introduced, they told you about the donation to the American Brain Foundation. I'm a big believer in giving back. You know, there's lots of people always hurting more than us. We should all try to do everything we can to give back and help others. I've kind of lived my whole life that way. I believe in it. But you know what? If we have, and I didn't do this in my trust because in 2012, I didn't think of some of the things that I know now. Why not permit charitable beneficiaries? If I have charitable beneficiaries, I can't let the trust pay off a pledge I made, say to the American Cancer Society, another great organization. But I could call up Brian and say, Brian, you hold the strings to determine an allocation to charity in my trust. Please have $10,000 being given to the American Cancer Society. Done. Now, it's not discharging a legal obligation because I have no pledge outstanding. But if I wanted to give 10 grand a year to the American Cancer Society, Brian can go direct the trust to do it. It's an indirect kind of access. The home behind me that you see, this wall, this residence is owned in an LLC owned by our non-reciprocal spousal lifetime access trusts. If I'm nice to my wife, she lets me live in the home that's owned by her trust. If I'm not nice, I may have to stay outside. So the point is, if we have a residence that was bought by the trust, I can use it. Access, tax reimbursement, another aspect. The independent trustee can reimburse for income taxes. And I'm going to skip the sample language. Now, the next 5 pages I'm going to completely skip. These are technical ways you can differentiate one spouse's trust from the other to avoid the reciprocal trust doctrine. You don't have to be expert, but if somebody is copying the trust, it's not going to work. You need significant differences. One spouse's trust has to be drafted independently as a different, unique document from the other. I like different jurisdictions. I like different trustees. I like different assets. Now, when you're doing slats, should one spouse or two spouses do slats? Your client's worth $50 million. Maybe they should both do slats and put in the 11.7. What about a client that's worth $16 million? Slide 41. Does husband and wife both do a slat? How much money can a $16 million net worth couple be comfortable giving away? I said, let's assume they're comfortable giving away $8 million half their net worth. And just for the record, that's a lot. There's rules of thumb that you probably shouldn't give away more than 30%. And forget the rule of thumbs, you should do some financial modeling to see how they're going to survive. I don't mind if a client down the road may want to access money in a trust, but I really would prefer that for the next 3 to 5 years, they don't touch the trust if they can avoid it. It helps make it look like there was no implied agreement with the trustee to get a distribution. I like institutional trustees because that avoids any argument, I think, of an implied agreement. If Uncle Joe or Aunt Jane are the trustee, IRS can argue or credit can argue they had an implied agreement to get money back. And by the way, and we don't have time to get into it, and this would be a great topic for another program, you all need to be sure that you're familiar with the concept of a directed trust. Can one of you from BUI shake your head yes or no if you think everyone knows what a directed trust is? Okay, I got no shakes. You got to know about directed trust. If you're a financial advisor and I say I'm getting an institutional trustee for our mutual client, you're not going to be happy. You're going to immediately assume, all right, so now this guy Shenkman is naming some trust company. They're going to steal all the investment business. They're going to override everything I'm going to do, and I'm going to lose my client. No, 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 no. Most of the trusts I set up are directed trusts. I'll use an institution like Peak Trust Company in Alaska. They specialize in what are called being an administrative trustee. So I may name myself as the investment advisor or investment trustee of my trust, because if your client has a family business, they're not going to pay a trust company to manage the family business. They don't want the trust company's nose in it. The trust company I'm hiring, I pay a flat fee of X thousands of dollars a year. It's a fairly modest fee. I get the benefits of great state law, the independence of an institution in case I ever get sued. Think of all your doctor clients. The independence of an institution in case the IRS comes after me. For $3, $4, $5 grand a year, they don't do investments. They serve as an administrative trustee. So if any of you were getting chills when I was saying trust company in these different states, don't. It's not it doesn't have to be a full service trust company. It can be an administrative trust company, and the client can be in charge of their own investments. Now, one question: if the client's got 16 million, how much can they give away? Let's say 8 million. Slide 41. Going back to the slide, the knee-jerk reaction is spouse 1 sets up a trust with 4 million, spouse 2 sets up a trust for 4 million, and they each are beneficiaries of each trust. Not a great deal. First of all, it's double the legal fees, double the administrative fees, double the trust fees, and I've only used 4 million. What if the Biden administration knocks the exemption down to the 5 million uninflation adjusted amount that was in before the 2017 Tax Act? Because Biden has said he wants to revert and reverse a lot of the 2017 Tax Act. So they may go back to 5 million. If we've each given away 4 million, we haven't really captured much exemption. Contrast that with one spouse only puts 8 million, using 8 million of their exemption. The other spouse will still have 5 million. I've used 3 million more exemption by doing one trust, cutting the cost, the complexity, and the hassles in half. So that's something to think about. And oh, by the way, if I do a trust for my wife and she doesn't do a trust for me, do I have a greater mortality risk to think about? Yes. And we can use some of the other techniques. Now, We only have 6 minutes left, and I told you we weren't going to get through everything, but hopefully what I've discussed on SLATs, which has become the most popular tool, you understand what the reciprocal trust doctrine is. You understand how you got to have some analysis done. You understand it may be one spouse and not two. You got to figure out what really makes sense for the client. You understand you have to differentiate the trust and the assets in the trust. Too many people do these in too simplistic of a way. Now, with the time left, let me talk about some other creative ways you can get access, because I just want to add, if they're not already in your toolkit, some other concepts. These your clients will love if they're not being brought up. What's ADAPT, a self-settled trust? A domestic asset protection trust. Marty sets up a trust, and Marty's a beneficiary of his own trust. Oh, how can that be? Well, in most states it can't be, but now 19 jurisdictions permit me to set up a trust and me to be a beneficiary of my own trust. So if I'm a beneficiary of my own trust, God forbid my wife dies prematurely, do I have to worry about access? No, I'm a beneficiary. What a great way to give access. The only issue with these trusts, assuming they're operated properly, is if I live in a jurisdiction like New York or California or Florida that has public policy against such trusts, and the client goes to South Dakota or Delaware, which permit these trusts, will the trust work? The law is not clear. What I do believe can be done, if you're going to live, if a client lives in California and wants to set up a trust like this in South Dakota, have all the contacts in South Dakota, name a trust company in South Dakota. If you have LLCs owning business or securities, set those up in South Dakota. Don't have anybody in California serve in any capacity. So if Michael lived in California and I was in California, I wouldn't let Michael be the guy holding the loan power that we talked about earlier. I'd name Brian, who lives someplace else. Cut the ties with the home state, enhance the ties with the other state. Great, powerful tool. And now 19 jurisdictions permit these kinds of trusts, and there's nothing really clearly saying they don't work in other jurisdictions, although the risk is perhaps somewhat greater. Great planning opportunity. And I give you all kinds of sample stuff you can show to the client's lawyer. Let me give you two more concepts before we wrap up, because these will really emphasize the flexibility to make sure clients have access. And don't forget some of the off-label stuff I told you about: loans, charity, vacation homes, tax reimbursement. These are structural mechanisms. And then I have one final point on SLATs that I want to drive home when we're done. So let's say your client lives in California, Florida, New York, that seem to have a public policy suggesting that these domestic asset protection trusts aren't viable. It's not clear they're not, but the risk is certainly greater. So here's what I'm going to do. Instead of me setting up my DAPT where Marty's a beneficiary, I'm going to set up a trust for spouse and descendants, my wife, Patty, and all our kids and grandkids. And I'm going to give Brian, in a non-fiduciary capacity, the right to add Marty Shenkman back as a beneficiary. You can't say it's a self-settled trust and apply California, Florida, New York kind of law to attack it, because I'm not a beneficiary. And because Brian's in a non-fiduciary capacity means he has no standards that he's held to. So I better trust Brian, right? I may have to refer him a lot of work to make sure he does the right thing when I need to be added back. But if Brian holds the power to add me back, you can't force him to do it. He has no obligation to. But if 10 years from now I need some money, and let's say there's 10 million bucks in the trust, let's divide the trust. Make one trust own 9 million, another sub-trust own only 1 million. Brian, add Marty back as a beneficiary to the $1 million trust. Why? Because now I'm not a beneficiary of the 9 million. I never was. How do you attack that? I don't know how you can. But I'm only a beneficiary of the $1 million trust. So if it turns out the DAP doesn't work, 10 years from now, we only jeopardize 10% of the money. But I can get at it. It's another way to get access. That's often called a hybrid DAP. Now, there's another concept called a SPAT, Special Power of Appointment Trust. And I can explain it really simply just as a spin on what we just talked about with the hybrid DAP. Instead of Brian adding me back as a beneficiary, because now arguably that $1 million trust that I get added back to, I'm a beneficiary of, and someone could challenge it. I'm going to give Brian a different kind of power. Brian, in a non-fiduciary capacity, I'm giving you the power to tell the trustee to give me a distribution, kind of like the loan power. So Brian can call up the trust company. Hey, Peak Trust, my name's Brian Siegel, and I hold a special power of appointment in Marty Shenkman's Spousal Lifetime Access Trust. I'm exercising that power. I just sent you a signed letter. Give Shenkman 250 grand. They got to give me 250 grand. Brian's creditors can't get at it. Brian's estate can't get at it. It's a limited or special power of appointment. Until he exercises it, I don't know how somebody can nab it from me. What a great way to provide access. Now, what I want to do, and there's sample provisions to show the lawyers and everything else. Let me take a minute and just summarize. Spousal Lifetime Access Trusts for married clients are a great tool. Do them right. We gave you lots of tips on that. If a client is single and wants to get exemption used, use the self-settled trust, the DAPT, hybrid DAPT, or SPAT. But here's a twist for married clients. Why should my wife and I do non-reciprocal slats? Maybe my wife does a hybrid DAPT and I do a SPAT. You get more access, and the trusts are even more differentiated to negate the reciprocal trust doctrine. So don't let your client's lawyer acronym you. Creatively take all these different mechanisms that we just talked about, and they're all in the handout if I went too fast, and make the trust more robust, more accessible, and very different. You can accomplish a huge array of goals. Now, I know we're out of time. Can I get 3 more minutes just to tell you something very cool on how GRATs should be totally different this year? And oh, by the way, to entice you to give me 3 more minutes, it's got a very cool insurance component. I know you guys aren't interested in insurance, but maybe some of the audience is. Can we do that? So let me explain what a GRAT is. GRATs, Grantor Retained Annuity Trust, very common, popular planning tool. I take and put $1 million in a trust. I'm going to get the money back as an annuity over 2 years. That's the minimum term, along with a stated interest rate, the IRS 75/20 rate, beyond what we can go into today. That just is what it is, and you use software. Everyone uses software and makes the calculation. That's the plain vanilla GRAT. The traditional way GRATs have been done is you would set up 5 GRATs, 10 GRATs, and put a different asset class in each GRAT. Because what a GRAT excels at is slicing off upside volatility. So if I had 5 GRATs done last year, and one of them had the NASDAQ, and one had a real estate REITs, and one had maybe the S&P, the S&P would have gone up some, but boy, that NASDAQ GRAT would have been a grand slam, right? All the return above the 75/20 rate, the mandated interest rate, which is like less than 1%, I think now. It's ridiculously low. All grows out of my estate. Now, one of the interesting historical applications, we used to use GRATs so that back end of whatever grew out of the estate would roll into an insurance trust. Why would we do that? Because we didn't have to worry about premium financing or split dollar life insurance. We didn't have to worry about naming, everybody the client ever said hello to as a crummy power holder, which, probably violated Chris Stefani and was excessive and could be disavowed by the IRS. We just rolled GRATs into the ILETs, had plenty of money to buy life insurance. Granular GRATs, sometimes with the insurance on the back end. Now, what's unique about GRATs this year, right now, in the current environment? And oh, by the way, slide 59 talks about GRATs as an ILET funding tool. And that's still a neat thing to do because, hey, one of the changes that the Democrats have talked about is capping per donor annual gifts at 20 grand. And by the way, that's a really important point for everyone that does anything with life insurance. Most insurance should be held by insurance trusts. With rare exception, maybe it shouldn't. But in almost all cases, the default plan have an ILET own the insurance, so it's out of the estate, protected from creditors and so on. But if you had crummy powers where you're getting 50, 80, 100 grand a year into that insurance trust to pay for premiums, if they cap it 20 grand per donor, right now it's 15 grand per donee, you got a disaster. You can't fund your insurance. So a last minute change like that could be good. Here's the ground rules for a GRAT. And I just heard some really smart people talk about GRATs on a webinar I listened to yesterday because I like to hear what other people are talking about. They completely missed the boat. Here's what should be unique about GRATs right now in this environment. If the Democrats put through their tax changes, for a decade they've been talking about getting rid of GRATs because GRATs are just too good of a tool and they've wanted to restrict them. The proposals talk about mandating that if you put $1 million in a GRAT, you have a minimum 25%, $250,000 taxable gift. GRATs will be over. They're also talking about mandating a minimum 10-year term. That'll eliminate most GRATs because the way GRATs work, and we just don't have time to get into the detail, is 2-year rolling GRATs, and you slice off upside volatility and keep rolling the GRATs. But because GRATs may be virtually eliminated or so restricted that they're useless after this next tax bill comes through, which I believe will happen, what you want to do while interest rates are so low, and that's all anyone's talked about, lock in GRATs now. But if I do a 2-year GRAT, the whole foundation of GRATs is every 2 years you keep rolling them into new GRATs. But if the law is going to change and we may not have GRATs after this year or after June of this year, I can't roll the GRATs. I lose the whole premise of how GRATs have traditionally been done. So doing a typical GRAT just probably don't make any sense. Now, if I have a client with a family business and I want to use GRATs because we've already used up the $11.7 million exemption, and I know I won't be able to, or I anticipate I won't be able to roll them, maybe I need to do longer term GRATs. Maybe I'll do a ladder of GRATs. Why? To address mortality risk. Generally speaking, and it's not fully true, you have to outlive the term of a GRAT. So if I have a client that's 75 and's got a chunk of family business, we've already used their exemption, done note sales and everything else, maybe the rest of the family business I'll gift to GRATs. I'll do a 4, 6, 8, and 10-year GRAT. If the client lives to year 9, the 4, 6, and 8-year GRAT are completely out of the client's estate. The 10-year GRAT will in part or in whole be in the estate. So that's a different approach to GRATs that you have to look at with clients because they may not be around anymore. So if you see a client doing a whole bunch of 2-year GRATs, blow the whistle and say, why are you doing that? You can't roll them. That's the traditional application. Maybe lock in these low interest rates in the great mechanism of GRATs over a longer time period. Can any of you at BUI think of an issue when you have a 10-year GRAT or a ladder of GRATs? Mortality risk. In contrast to the traditional 2-year GRAT, if the client is convinced that this is a great technique, and I think it's a great technique in the right circumstances, and they're going to do a 6, 8, and 12-year GRAT, talk to them about insurance. When I've done this, what we have done is we've then, let's say, we priced out a 4-year term, a 6-year term, 8-year term, 10-year term policy. No one's ever done that in real life. What we've then done is said, listen, instead of getting, just to show you the illustration of $1 million 4, 6, 8, and 10-year term policy, why don't we just buy a $5 million 8-year term policy? You know what? It'll cover most of the mortality risk, and it's simpler. Throw it in your existing ILIT, because clients doing that level of planning probably already have an ILIT. We've insured the mortality risk of a GRAT. Fits perfectly, just like the wealth replacement trust. Last thing, because I know we're over time, but this is just too cool not to say. So at the end of the football game and you're down by 6, you throw that long pass, right? Hail Mary. So here's the estate tax equivalent to Hail Mary. We hear there's going to be a tax change. Client didn't do any planning. What can we do at the last minute? We're living in an interest rate environment where interest rates are at historic lows. So if a client's got a $100 million business and they haven't done any planning, and the new law is like just coming around the block, throw a Hail Mary. Throw the whole business into a 99-year GRAT and see what happens. Oh, but wait, no one's going to live 99 years and the client's already 70. How does the GRAT work? People mistakenly think that when you die during the GRAT term, all the assets of the GRAT are pulled back into your estate. That is not correct. What's pulled back into your estate is a mathematical calculation. The annuity amount you were paying on the GRAT divided by the 75/20 mandated IRS interest rate in the year you die. So if a client does a GRAT today and they die in 15 years and interest rates are 4 times what they are today, the bulk of that business is going to be out of their estate. It's a pure interest rate play. So we're going to have to stop. And if you want me to answer a couple of questions, I can do it. But I think we are living in an incredibly uncertain environment. Uncertainty means opportunity for you to guide clients. I've given you a whole lot of clever tips and planning ideas. I've tried to caution you about some of the stuff that I see being done really not optimally across the board. And I've tried to target most of my comments back to what you do as financial planning professionals. I've hinted at some of the legal things because if the lawyer's not bringing it up, you can, and there's great materials there to deal with it.
Marty, thank you. I love the enthusiasm that you have for the topic. It makes it really engaging, and you must be exhausted at this point. But we do have a few questions.
This was actually decaf coffee. If you want the next speech, I'll have a double cappuccino. We'll really cover ground.
Yeah, believe it. So just a couple of quick housekeeping items before we get into the questions. If you do have questions, please submit them in the chat just so we can keep it all together. Number one is if you haven't signed up for CE, please do that. I put the link a couple of times in the chat features. We've gotten several questions about slides and the recording. I will be sending the slides and the recording to everybody that attended the meeting. Please, if you don't see it by the end of the day tomorrow, please check your spam filter. It will be there. So getting into the questions, one of the first question here, you provided sample language. And again, we have a lot of financial planners on the call here. Do you generally find that attorneys are receptive to a financial planner providing sample language to an attorney?
I'm going to give you the standard legal answer, but this is very important. It depends. It depends. So if you as the financial advisor go to the client and say, here's sample legal language that your lawyer should have, there's not going to be a lawyer on the planet that would be happy with you, and I think they'd be rightfully justified. If you pick up the phone and call the lawyer and say, hey, you know, we talked about this idea of using a formula gift clause to make a gift to address the risk of a retroactive tax change. Have you dealt with that? If you haven't, you know, be respectful. If you haven't, I have some sample language I got on a webinar I can send you if you'd like it. Happy to send it to you. I mean, I think if you do things in a collegial and professional way, why would anybody be unhappy? I think if you're showing up the client at a meeting or circumventing and going behind any of the other advisors' backs, they're not going to appreciate it. And by the way, when you do that, then that's what you get back. You know, to me, anytime I go into a meeting, I view every client as introducing me to, you know, potentially 3, 4, 5 new COIs to refer information, you know, refer business to me, right? I love when a wealthy client comes to me and I don't know their accountant, I don't know their financial advisor, I don't know the trust company they're working with, and I meet new people that can all be sources for me to expand my network. And I think if you treat it in a positive way and put the client's goals first, you can do it. And in the end, whether you get credit from the client or not, the client's going to be happy when the planning is done well. The client's going to sense when the team is working really well, and they're not going to be happy when the team is conflicting.
Good advice. Thank you.
And that's what I tried to give all of you with these materials. I mean, there's way more than you can cover in an hour webinar here. But you know, if you have an issue come up, you can go back and look at it. If one of the other advisors is not familiar with something, there may be enough here to get them going. And listen, if the advisor really is not comfortable or familiar with it, is it, you know, at some level or at some point, the attorney, using your example, might say, listen, this is beyond what I'm really able to do. Can we bring in co-counsel? And there's plenty of people around the country like myself who will co-counsel and guide somebody and not try to steal the client. And there's no reason to. There's no reason to.
Very good.
So it can be a win for everybody, especially the client.
Good. Thank you. So the next question, can you speak to the planning opportunities presented with promissory notes given the low interest rate environment?
So let me differentiate. a concept. There's this idea that's been talked about a lot called the gift of a promise. So I have, 12 million bucks sitting in my brokerage account, but I'm not going to part with a penny because I want to see 12 million bucks sitting in my brokerage account. So I'm going to write out on a piece of paper a note and give the note to a trust. It's called a gift of a promise. There's been a lot of talk about that. I've seen some situations where I actually recommended it to a client. I couldn't get a client to bite. Just be careful with that. I'm not sure that's what you're talking about, but I just wanted to differentiate that. And my understanding, and I haven't researched it because I haven't found a client willing to do it, is that the only state law that permits the validity of a promise gift like that is Pennsylvania law, and you may have to get Pennsylvania co-counsel to do it.
Okay.
Now, in terms of low interest rates, we're in a historic low interest rate environment. So that can play out in positive ways with lots of different kind of planning techniques. So you could do, split dollar loans, right? You can sell the family business to a grant or trust for a note, and the interest rate on the note is almost obscenely low, right? And that helps with the value shift. You can loan money. Don't do this to the kids or the heirs. Do it to a trust. You don't want to make a multi-million-dollar loan to a kid and have them invest the money. If the client's already spending millions of dollars on a loan transaction to arbitrage interest rates versus return, make sure it's in a trust so that growth is out of the estate, protected from the heirs' divorce, right? We still have a 50+% divorce rate. You want to protect it. And also the mechanisms of safeguarding it and GST allocation, you can't do that. And by the way, GST allocation is critical because that's something else the Democrats have proposed eliminating. So if you get a trust set up new and you make the loan to a trust so the value inures inside the trust that's GST exempt, it'll work. Very important from a matrimonial and tax perspective. If a client's going to listen to my advice and set up a trust and not do it direct to the kids, make sure there is at least some gift to the trust. You need a $100 gift, a $1,000 gift so you can allocate GST exemption. The accountant can do it on a gift tax return. But with these low interest rates, there's lots of techniques from a pure loan and then the kid invests it to sale of assets like a family business. You could sell an LLC holding marketable securities to trust for children and grandchildren and others. But hey, before you do that, why not use the slats and other mechanisms we talked about so the client has access? If you make the loan just to a kid and they're increasing their wealth, what if you need it? And if you don't need it and it's in a slat, all the distribution can go to the kid, but at least you preserve that flexibility. I think you want to be as flexible as possible. Make sure that if you do any kind of loan transaction, you address the basics and that you go back in a year. If you put on your calendar, if the loan is done February 5, so interest rate is due every year February 5, if you can calendar that interest payment date, and every year, February 1, call the client and say, hey, don't forget you got an interest payment due on February 5. That'll help make the transaction work. And make sure there's a written loan document, that it's signed, that it's treated as a loan by everybody. And I'll tell you one of the places clients really mess it up. They're arguing with the IRS on an audit. No, it wasn't a gift, it was a loan. But then they treat it differently on the financial statement they report to their bank, or that the child or the trust reports to the bank. Just be careful to make sure they treat it consistently as a loan. If I didn't answer your question, ask me something more because I'm not sure if I did.
No, I think that you did. I also know that you have another meeting in 12 minutes. Are you good on time or should we wrap this up?
We can go eight more minutes.
Okay.
Keep in mind, though, if the client hasn't used their exemption, why are they making a loan? The exemption may disappear. Why not lock in the gift transfer? And if you use the techniques we talked about where the transfer is to a self-settled trust where I'm a beneficiary, my spouse is a beneficiary, I have loan provisions, all these other things, why not just make a gift? So one of the mistakes I see with loans is one of the mistakes I see with grats. Until the clients use their exemption, that probably should be the priority unless there's an economic or other reason why not.
Got it. All right, and the last question here, do you have planning suggestions if a high net worth client already used their full gifting exemption in 2020?
Of course. You want to know what they are?
I thought it was going to be, it depends.
Oh, no, that's of course. We've talked about some of them already. Grats are a great tool because if you used all your exemption, the exemption went up in 2021. It was 11.58 and it went up to 11.7. So they have a smidgen of additional exemption. So you can structure grats and do a tier of grats just like we illustrated. I don't like to zero grats out so there's zero value because I'm not sure what I'm reporting on a gift tax return. So I may structure the grats to have $1,000 gift value, just a hair of a smidgen of value. So now they have new exemption to do that. You can start using grats. You can sell assets for a note, just like we talked about. If they have chunks of family business still in their name, sell it to a grantor trust for a note. The interest rate on the note is very low, so that's a great arbitrage to shift value out of their estate. There's lots of things. You can do a loan as long as it's reported as a loan properly and treated as a loan.
Great. All right. Well, I think that that wraps up the questions. Marty, again, great job. Love the enthusiasm. It was a very entertaining presentation. I think I speak for everyone when I say I think we all learned a lot. To everyone that attended, thank you for your continued support and business through BUI. We'll get the CE filed in the next 72 hours. And again, I will have all the slides and the recording sent out before the end of the day tomorrow. Everyone, enjoy the rest of your day. And again, Marty and Protective Life, thank you.
Thank you, everybody.